Hello again. It's Friday, December 3rd, 2021. And I want to start with disclaimers. This is not investment advice. This is running through some hypothetical scenarios, some based off of historical data. So it's more of an exercise in trying to look at comparisons and what your options might be. So with that said, I want to say that I'm going to compare this investment in your 401k plan for 30 years and do the same with a infinite banking based whole life insurance policy, putting in the same amount of money for 30 years. So with that said, I'm going to share my screen as fast as I possibly can. And we'll start with a futures calculator. Now, I want to say that what I was able to do was look at the actual last 30 years because I'm going to project this into the future for 30 years, right? So with a 1% expense fee in a 401k plan, mutual funds, all that's made of, and this can work for, a market portfolio of any type, but I'm using the analogy of a qualified plan like a 401k. And so what I was able to do was run the S&P 500 /EFT for 30 years, 1991 to 2020. And with that 1% expense fee, the compounded rate was 5.87%. And I'm putting in what is the maximum amount for starting in 2022 next year. The maximum you can put into a 401k if you're under 50. I want to keep this apples to apples. I understand you can put more money in after you're over 50 or 50 or older. But the same goes for the policy. We're not stuck at, putting in this 20,500 only. So obviously your means matters on one side with the 401k, and then you're limited by this amount. The other thing is you're limited by your health, by your income or your net worth on the insurance side, but you very likely could put in more than this 20,500. So just so you see, it's going to refresh, but I'm going to hit calculation. We've already got what the future value would be in 30 years, right? So you see the period is 30. I'm not putting any additional, I'm not starting out with anything. So starting at 0, same with the policy, but you'll see. So remember this number, 1.6 plus million is what it's grown to. And then I want to move, I'm going to look at my notes here. I'm going to move to one of the illustrations of an insurance policy. Again, hypothetical, but I ran this 2 days ago on December 1st, 2021, and I did it for a male, 35, standard health, no tobacco use. And so he's pretty much middle of the road, healthy, 35-year-old male. This isn't sexist. This is me using what would be sort of the worst case scenario, because in most cases, a female cost for insurance is less expensive. And so this is, probably the worst case scenario is using a male. That being said, I want to say that in these projections, we have a guaranteed side and we have a non-guaranteed side. As you can see right here, I'm going to use the non-guaranteed assumptions, and that's based off of the dividend scale rate that is in use today with this particular insurance carrier. And so even though it's non-guaranteed, we're talking about non-guarantees really even on the portfolio or the 401k side. just because they're using historical numbers in projecting that out into the future. And that's what I just did with the future values calculator. We know that there's no guarantee just because what happened the last 30 years is going to happen again, better or worse, right? We don't know. We don't know on this policy side, whether they're going to pay the dividend scale today, over the next 30 years exactly. The one thing I can say is this particular insurance company has been paying consecutively a dividend for 116 years. And in most of these mutual insurance whole life carriers been doing something similar that pretty much their entire existence through all kinds of different economic times. They continued to pay a dividend every year. It has varied, but we are on the lower side of that scale right now. And so I wanted to at least point that out, and I want to tell you what number I'm going to use to compare. And when you're 65, there's $1.1+ million in the cash value of this policy. So again, non-guarantees, but that's your cash value. And I wanted to show you that. So let's go to my whiteboard document that I've created, and we're going to talk about the lay of the land here. And I've already done some highlighting here. We're talking about a 35-year-old male, standard health, investing or paying $20,500 a year for 30 consecutive years without fail into a 401k. And then what it looks like if you're doing this in an infinite banking whole life policy. So we saw this number in the calculator that I just showed, this 1.6+ million over a 30-year period at 5.87%. I utilized, I think, a very conservative combination of federal and state income tax, really based it off of 20% federal and 3% state, which is very conservative. 41 of 50 states have an income tax, and some of them have a flat, some have a progressive, meaning depending on the more money you make, the higher the income tax rate. And I think at 3%, if you look at, you can do the research, 23% overall is pretty conservative. Okay, so I backed out the taxes on this side. And so this is what you have as a post-tax value if you took it all in one hit. Now that we don't know what's going to happen either, right? We don't know what the rates will be 30 years from now. But, we're trying to do this apples to apples and what we have for information today. And of course, on this side, we had put the money in post-tax or already paid our taxes. So we're still left with this 1.1+ million. And then what I tried to do was say, let me go back to this illustration, but I used what would it, to stream out $59,000 a year out of each one of these accounts, so to speak. This being an account, this being a policy, we're going to project, $59,000 a year. Now, I want to bounce to this Vanguard nest egg retirement calculator that I had showed in my previous part 1 video, and remember that we had that it was 1.291, but I'm going to round that up because I have to with this particular calculator. So let me just scroll here and show it's for, how long does it have to last for? It's 30 years. I'm going to move this to the 1.3. And how much money do you spend a year? Well, I'm saying I'm going to spend every dollar of that 59,000, right? Now, 59,000, I'll show you how I came up with that number. But let's just run this first, right? Let's see Well, actually, no. Let me show you how I came up with this number. So I'm going to come over to this illustration again, same illustration, but now I'm going to show what it's like to stream the money out. Now it put money in for 30 years, see it over here. And then I stop in year 31, but I start to stream the money out. Now, just so you know what that column is where it says 50, here, let me highlight that, 59,176. Let me show you what that is. It's a partial surrender. Now, that means that you're taking this money out and you're streaming it initially out as what they call cost basis, which means every dollar that you've put in. And then there's obviously been some growth in this policy. So at one point, you can see your age. You can see this is the age column right here. You can see that it's going to continue to be 59,176. And starting at age 76, you're going to start streaming it out as loans. Now, you don't have to pay these back because they're just using your net cash value as collateral. So initially, the first year, 76, you're taking part of your cost basis and then taking the rest in loan. It all adds up to this 59,176. And then we want to run this till you're 95 years old and be left with, basically no money left in the policy. So 59,176. Scroll down and eventually, right, it's gone, right? So there is a little bit of money left. This is your cash value at 97, but if you passed away, we're just showing 59,000. So that's how I came up with that. Now let's go back to the calculator. All right, hopefully that wasn't confusing. So I'm going to use this. I rounded it down to 59,000, and I want to see what the probability is that I'm not going to run out of money in that, before that 30 years is up. So we're going to run the simulation. So there's an 82% chance on the 401k side that you're not going to run out of money. Well, I'm going to show you what it takes. All right, let me go back to this document, and I'm going to explain this a little bit more. So both sides were streaming from age 66 to 95, 59,000. Then we're talking about probability this will last for 30 years. I already showed you the 32%, the 82%, sorry. And the probability on this side that you'll still be able to stream that out. Now, this is another disclaimer, right? I want to go to this idea of how I came up with the 99% with a plus or minus of 1.25% probability, right? So this disclaimer, as you'll see here, is, in fairness, the 401k is using the past 30 years, 91 through 20 of the S&P 500 and the SPDR EFT performance, with a 1% expense fee, as I've mentioned. All right. Now, if we were to use the same historical performance with the dividend rate with this life insurance carrier, we'd be using 6.9% to project a 30-year future, because that is where the mean is of the last 30 years of the payout on this so-called it's a non-guaranteed dividend, but once they pay it, it's locked in. That amount will never be subject to volatility like the market dollars are. Once they're in there, you don't lose them. They're not at risk. But because today, actually as of yesterday, this carrier is paying 5.2% on a dividend scale rate. Now, I want to talk about this confidence level of the 99% chance. Well, to have a 99% chance of being accurate, within a plus or minus 1.25. It should actually say 1.25 down here because it is 1.25, and I did put it correctly up here. Now you have to have a sample size of at least 10,651. Now, with that said, this 30-year history of paying out dividends, again, hypothetical, not guaranteed, that equates to 10,950 days. So we've met the requirement to reach a 99% probability. But because of this plus minus 1.25, I backed that out and they said, well, let's round it down to 97% probability. So we're still 97%, 59,000. Now, to do the same on this side, we want to figure out, well, how do I get this to move up, this 82% probability to move up to that 97%? So let's take off, let's take off, I don't know, 50,000, and let's run it again. It's 92%, so we're still short. Maybe if we back out another 5,000. We're at 96%. Okay, how about, let's try 43. Okay, so it is between 42 and 43. I did round it down to 42, but hey, we can say it's 43. 97% chance that you're not going to run out of money if you lower it to 42,000, right? It didn't change. Again, those are simulations, just like this is all hypothetical simulations that I'm doing. I'm not guaranteeing anything, but a side-by-side comparison shows that you have a great chance of having to stream a lot less money out of your 401k plan. And I want to point out something else. I made a very strong, because of the capitalization, uppercase income stream, uppercase cash flow stream. And that's because this is still income over here. It's still something that can be used in other calculations for other programs like Social Security, and making sure you don't get taxed, or if you're showing income, it's potential you could get taxed if you're showing income when you try to go to get Medicare or any of these other government programs. They always look at your income. But on this side, if you built up your own personal pension plan, it's cash flow. It's not income, right? It doesn't get reported anywhere, right? So that's a big distinction. So I am going to get into part 3 next. Please hit the like button. Please think about subscribing, trying to get the word out about people's options. And I really appreciate your time, and I hope you have a great day.